If you were born before 1971 and you're receiving a pension or Social Security right now, there is a good chance you are paying more in federal taxes than the law actually requires. Not because you did anything wrong, not because your accountant made a mistake, but because no one told you to fill out a piece of paper. That is what this video is about. And before you think this is some complicated loophole for people with expensive financial advisors, I want to be clear. Every single form we are going to talk about today is free. Every one of them comes directly from the federal government. You can download them tonight. The question is just whether you know they exist. Here is the number that put this in perspective for me. As of this year, the average federal tax refund is nearly $2,900. Most people see that and think, great, I got money back. But think about what that actually means. You gave the government an interest-free loan of almost $3,000. They held it for 12 months, and they paid you nothing for it. Meanwhile, a basic CD or savings account right now is paying 4% or more. That is real money you left on the table every single year without realizing it. Now here is where it gets more specific to you. If you are in the middle, not in poverty, not pulling in $200,000 a year in retirement, you are actually in the most exposed group. The income thresholds that determine how much of your Social Security gets taxed, the rules that decide how much your pension provider withholds, the Medicare surcharge brackets, all of them were designed for a different era. And none of them were updated to find you and tell you the rules changed. That is your job, and most people do not know the rules. So today we are going through 4 forms. Each one addresses a different way money is leaving your pocket that you may not have noticed. I am going to give you the specific numbers, the specific scenarios, and the specific documents in plain language. The last form is the one I have been saving. It has the highest single-year savings potential of anything we cover today, and almost no one files it. I will tell you exactly why when we get there. Let us start with the one that is already affecting you this month. Not next April when you file, this month when your pension check arrives. If you receive a pension or annuity, your plan administrator is required by law to withhold federal income tax from every payment. That part most people know. What most people do not know is what happens by default if you never told them how much to withhold. If you never submitted a withholding certificate, your payer is legally required to treat you as a single filer with no adjustments whatsoever. That is the highest possible withholding rate for your income level. It does not matter if you are married. It does not matter if you have a larger standard deduction because you are over 65. The default is single, no adjustments, maximum withholding, until you tell them otherwise in writing. The form that changes this is called Form W-4P. It is the pension equivalent of the W-4 your employer used to have you fill out when you started a job. And the IRS just updated it for 2026 to make it even more specific, adding a new checkbox that lets you elect zero federal withholding entirely if your income level supports that. Let me show you what the default is actually costing in a real scenario. Say you are married, both of you are 65 or older, and your combined adjusted gross income from pension and other sources is $60,000. When you file jointly, your standard deduction this year is $31,500. On top of that, because you are both over 65, you each get an additional $1,550. So your total deduction is $34,600. Your actual taxable income is not $60,000. It is closer to $25,400. Now here is the problem. If your pension administrator is withholding based on the single, no adjustment default, they are calculating your taxes against the full $60,000 at the single filer rate. The difference in monthly withholding between that default and your actual tax liability can be anywhere from $150 to $300 per month. Over a year, that is $1,800 to $3,600 you handed to the IRS with no compensation in return. That is not a rounding error. That is a deliberate choice the system makes for you when you do not make one yourself. Submitting a W-4P does not mean you stop paying taxes. It means the amount withheld each month actually matches what you owe. For most married retirees over 65, even filling out Step 1 and Step 5 with your correct filing status and leaving everything else blank brings your withholding significantly closer to your real liability. Find it at irs.gov. Search W-4P. It is one page. Now, your pension is one income stream. If you are also receiving Social Security, that is an entirely separate withholding system, with its own form and its own set of rules that have not been updated in 4 decades. In 1983, Congress passed a law that allowed Social Security benefits to be taxed for the first time. When they wrote that law, they set income thresholds. If your combined income, which is your adjusted gross income plus any tax-exempt interest plus half of your annual Social Security benefit, stayed below $25,000 as a single filer, your benefits were completely tax-free. Between $25,000 and $34,000, up to 50% of your benefits could be taxed. Above $34,000, up to 85%. For married couples filing jointly, those thresholds were $32,000 and $44,000. Here is what makes this counterintuitive. Those exact dollar amounts, $25,000, $34,000, $32,000, $44,000, have not changed once since 1983. Not once in over 40 years. Every other part of the tax code gets adjusted for inflation every year. Income brackets, standard deductions, IRA contribution limits, all of them move. These thresholds do not. So what has happened over time is a slow automatic expansion of who gets taxed. When the law took effect, fewer than 10% of Social Security recipients owed any federal tax on their benefits. Today, that number is close to 56%. You did not get richer in real terms. Your benefits just kept getting cost of living adjustments while the finish line stayed in the same place. There is a specific mechanism worth understanding here because it catches people who think they planned carefully. Right now, with the 10-year Treasury yield above 4%, a lot of retirees are doing something sensible. They are putting money into CDs, Treasury bonds, or savings accounts because the rates are actually worth it for the first time in years. That interest income flows directly into your combined income calculation. If you have $200,000 in a CD ladder earning 4%, that is $8,000 in interest income added to your combined income total. For a couple that was comfortably under the $44,000 threshold, that $8,000 could push them past it and expose 85% of their Social Security to taxation, just from one prudent financial decision. The form that gives you control over this is Form W4V. It lets you choose voluntary federal tax withholding directly from your Social Security payment. Your options are 7%, 10%, 12%, or 22%. You pick the rate that matches your actual estimated liability based on all your income sources. The problem is that most people either did not know they could do this or they left it at zero and are now facing an unexpected tax bill in April, along with a potential underpayment penalty. The smaller group made a choice years ago and never revisited it, meaning they are now over withholding because their income changed. Both outcomes are a loss. The form lets you correct either one. There is a legislative footnote worth mentioning here, not as a reason to wait, but as context. Senators Blackburn and Marshall introduced a bill specifically to raise and inflation index these thresholds. If it passes, the single filer cutoff would move from $25,000 to $34,000. But that bill is not law yet. Till it is, the current thresholds apply, and your best tool is the W4V. We have now talked about two forms that both deal with the same basic problem. Your withholding does not reflect your real tax situation, but the next form is different. It is not about adjusting what gets taken out. It is about preventing the IRS from taxing money you already paid taxes on once. 2216. If you ever made what is called a non-deductible contribution to a traditional IRA, you need to understand what Form 8606 is, because without it, that money is going to get taxed twice. And the IRS will not stop it from happening. They will not flag it. They will not send you a notice. The default assumption when you take a distribution from a traditional IRA is that every dollar is taxable income. Proving otherwise is entirely your responsibility. Here is how this works in plain terms. When you contribute to a traditional IRA and your income is below a certain limit, your contribution is deductible. You get a tax break going in, and you pay taxes when the money comes out. That is the standard case most people understand. But if your income was above the deduction limit in a given year, or if you or your spouse had access to a workplace retirement plan, you may have made contributions with money you already paid income tax on. After-tax dollars. Those contributions are called non-deductible. And the portion of your IRA that came from non-deductible contributions, your basis, should not be taxed again when you withdraw it. Only the earnings and any previously deducted amounts should be taxable. Form 8606 is the document that tracks this. It is your proof. It is the running record you file with your tax return every year you make a non-deductible contribution, and every year you take a distribution. That tells the IRS, this portion has already been taxed, do not tax it again. If you never filed it, that record does not exist, and when you take a distribution, your payer sends you a Form 1099-R showing the gross amount. The IRS sees that number. Without a corresponding 8606 establishing your basis, the entire distribution looks taxable. Let me give you the specific scenario that plays out more often than most people realize. Someone contributed $7,500 to a traditional IRA in a year when they were not eligible for a deduction, after-tax money. The account grows to $8,000. They take the full distribution. Their CPA gets the 1099-R showing $8,000. The CPA does not ask whether any of those contributions were non-deductible, because that conversation never happened. No 8606 was filed. The full $8,000 gets reported as taxable income. The correct taxable amount was $500, just the earnings. The other $7,500 had already been taxed when it went in. At the highest federal tax bracket, that mistake cost roughly $2,700 in a single transaction. Now multiply that across multiple years of non-deductible contributions accumulated over a decade or more of retirement savings, and you start to see how significant this gets. The basis does not disappear just because you forgot to track it, but recovering it requires filing amended returns, reconstructing contribution records, and in some cases starting from scratch with IRS wage and income transcripts. It is recoverable, but it is a much harder problem than simply filing the form on time. There is one more wrinkle that makes this particularly easy to miss. Form 8606 is only required in specific years: the year you make a non-deductible contribution and the year you take a distribution or do a Roth conversion. If years pass between those two events, you are not required to file it. And that gap is exactly where the record gets lost. You change tax preparers. A spouse passes away. You move, life changes, and nobody carries the file forward. When you finally do take that distribution 10 years later, the basis exists, but the documentation to prove it does not. Some tax professionals recommend filing 8606 every single year, required or not, simply to keep the chain unbroken. That is not bad advice. If you are not sure whether you have non-deductible basis in a traditional IRA, the starting point is finding the last Form 8606 you or your preparer actually filed. If you cannot find one, you can request wage and income transcripts directly from the IRS, which include historical Form 5498 filings from your IRA custodian showing contribution amounts. It is reconstructible. But sooner is significantly easier than later. Now we have covered 3 forms: 2 that adjust withholding on current income, 1 that protects money you already paid taxes on. The last one is different from all 3. It does not adjust anything, it appeals something. And the savings potential in a single year is larger than everything else we have talked about combined, for the right person. But here is what makes it unusual. The people who need it most are often the ones who just did something right. They just retired. They just made the transition they planned for. And because of a 2-year timing mismatch built into Medicare's billing system, their first months of retirement come with a premium bill that reflects a life they no longer live. Let me explain how this actually works. Medicare Part B, which covers doctor visits and outpatient services, has a standard monthly premium. In 2026, that standard premium is $202.90 per month. Most people pay that. But if your income exceeds certain thresholds, Medicare adds a surcharge on top of that standard premium. This surcharge is called IRMA, the Income-Related Monthly Adjustment Amount. It is applied in tiers. In 2026, the surcharge starts when your modified adjusted gross income exceeded $109,000 for a single filer or $218,000 for a married couple filing jointly. And it scales up from there in 5 tiers, with the highest tier reaching a total Part B premium of $689.90 per month per person. That is more than 3 times the standard rate, and that is just Part B. The surcharge applies to Part D prescription drug coverage as well. Here is the structural problem that creates the situation I want you to understand. Medicare does not use your current income to set your premiums. It uses your income from 2 years ago. The most recent complete tax return available in January 2026 is your 2024 return. So your 2026 Medicare premiums are based entirely on what you earned in 2024. For someone who worked a full year in 2024 and retired in 2025, this creates an immediate problem. Your 2024 return might show a modified adjusted gross income of $300,000, reflecting a year of full-time employment, a bonus, stock options, or whatever your working income looked like. You are now retired. Your actual current income might be $60,000, but Medicare is charging you based on $300,000. The specific numbers are not hypothetical. A retiree in that situation, sitting in IRMA Tier 3, is paying $527.50 per month for Part B alone. That is $324.60 above the standard premium every single month. For a couple where both spouses are on Medicare and both are subject to the same surcharge, that is $649.20 per month in excess premiums. Nearly $7,800 per year. Based on income, neither of them is currently earning. And here is the part that is genuinely worth sitting with. About 5.1 million Medicare beneficiaries paid Part B IRMA surcharges in 2025. That is approximately 7 to 8% of all Medicare enrollees. The majority of them received a letter, saw the higher premium, and paid it, because they did not know there was a form to challenge it. The form is called SSA 44. The full name is Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. It is a free form from the Social Security Administration. You can download it tonight. To file it, you need to qualify under one of 8 life-changing events that the SSA recognizes as justification for using more recent income data instead of the 2-year lookback. The list covers most retirement transitions: marriage, divorce, death of a spouse, work stoppage, reduction in work hours, loss of income-producing property, loss of pension income, employer settlement payment. If you retired, you likely qualify under work stoppage. If your spouse passed away and your filing status changed, you qualify there. When you file SSA 44 with supporting documentation, you are asking the SSA to use your current or projected income instead of your 2-year-old return. For someone who retired mid-year, that means showing your actual reduced income for the year of retirement and projecting forward. The SSA reviews it and can adjust your premium immediately. The savings range from $1,148 to $6,936 per person per year, depending on which IRMAA tier you are currently in and which tier your actual income places you in after the appeal. One detail that surprises people: you do not have to wait for IRMAA to be assessed before you file. If you have already experienced a qualifying life-changing event, you can file proactively. People who file before the surcharge is applied often avoid it entirely rather than paying it and waiting for a refund. There is also a cliff in this system that creates a specific kind of urgency. IRMAA is not graduated, it jumps in full tiers. If your income is $1 above a tier threshold, you owe the full surcharge for that entire tier for the full year, $1. If your income is $1 below it, you owe nothing for that tier. For a couple, that single dollar difference can be worth thousands annually, which means if you are close to a threshold, the income planning decisions you make this year, Roth conversions, timing of IRA withdrawals, timing of capital gains, directly affect your Medicare premiums 2 years from now. Most people do not think about Medicare premiums when they are making investment decisions in their early 60s. The connection between those two things is one of the most underused planning levers available to people in the decade before and after retirement. Now I want to step back for a moment from the mechanics. There is a pattern across everything we have covered today. The W-4P default overtaxes you if you do not opt out. The Social Security thresholds were set in 1983 and never adjusted, so more people cross them every year without earning more in real terms. Form 8606 only protects your basis if you maintain the record yourself, and Medicare uses a 2-year-old snapshot of your income that may have nothing to do with your current financial life. None of this is malicious. The government is not designing these systems to take your money. But the systems were built for average cases, and they were not designed to proactively find you and tell you when you qualify for something better. That is your job, or your advisor's job. And a significant number of advisors do not raise these issues either, because the approval process feels uncertain or because the client did not ask. The approval rate for legitimate SSA 44 filings based on qualifying life-changing events is high. It is not a long shot, it is a form. The only reason not to file it when you qualify is not knowing it exists. One more category before we close, and this one is the simplest of everything we have covered today. If you are 65 or older and you own your home, almost every state in the country has a program, sometimes several programs, that reduces or freezes your property tax specifically because you are a senior on a fixed income. These programs exist in California, Florida, New York, Texas, Washington, Colorado, and dozens of other states. They are funded, they are active. And the savings in many cases are measured in thousands of dollars per year. The reason so many eligible homeowners do not receive them has nothing to do with eligibility. It has to do with one procedural fact. These exemptions are not automatic. You have to apply. And in most states, the application window has a hard deadline that falls sometime in the first half of the calendar year. Miss it and you forfeit the exemption for that entire tax year. There is no retroactive recovery. New York ran the numbers on this recently. In 2024, 2.8 million homeowners received more than $3 billion in property tax relief through the state's STAR program alone. That is $3 billion that went to people who filed a form. For everyone who qualified and did not file, that money simply stayed in the tax rolls. Florida has a provision for homeowners 65 and older who have lived in their primary residence for 25 or more years. With applicable income limits, that exempts up to $250,000 of assessed property value from non-school taxes. Colorado exempts 50% of the first $200,000 in actual value for qualifying seniors. Washington State offers exemptions for homeowners 61 and older with household income below $88,998, which covers a meaningful portion of middle-income retirees in that state. The form varies by county and state. Start with your state's Department of Taxation or Revenue website, search for Senior Property Tax Exemption, and look at the income limits and application deadline. In many cases, the application itself is one page. What all of this adds up to across the W-4P, the V, Form 8606, the SSA 44, and the property tax exemption is not a collection of tricks. These are tools the government created specifically for people in your situation. The assumption embedded in each of them is that you will be proactive, that you will seek them out, and that you will take the action required to claim them. The system will not do it for you. It never said it would. The honest version of what I believe after going through all of this is not that anyone is cheating retirees. It is that passive compliance with default settings is quietly expensive. For the average household, the combination of incorrect pension withholding, unnecessary Social Security taxation, lost IRA basis, uncontested Medicare surcharges, and unclaimed property tax relief represents a real number. Somewhere between $5,000 and $15,000 per year, depending on your situation. That money does not disappear. It just goes somewhere you did not intend. The question I want to leave you with is this. If these forms exist precisely to protect people in retirement, why is there no obligation on anyone in the system to tell you about them? That is not rhetorical. I think it is worth asking your financial advisor, your tax preparer, and frankly your state representative. If this video covered something you had not heard before, subscribe. I am going to do a follow-up that walks through the actual line-by-line instructions for filing each of these forms, because knowing they exist and knowing exactly how to complete them are two different things. And drop a comment below telling me which of these 4 forms you already knew about before watching this. I am genuinely curious how many people are already on top of this and how many are filing for the first time.